Good afternoon, everybody. My name is Anthony Volin. I am the owner and broker of the Collective Realty. We're so happy to have you here again. You might be here because last week we had an amazing attorney talk to us about Tennent-in-Common and all the rules and how that works. And if you want to list a Tennent-in-Common as an agent, we have a separate webinar for that. So if you haven't seen that, make sure you check it out on our YouTube page. But today we're talking about financing and how to finance Tennent-in-Common and how that's different and what that looks like. So we'll get into that in just a couple minutes. But before we do, we're in election month. We're 2 weeks away from the election, and there's 3 ballot measures that are going to be affecting home ownership. So the first of the ballot measures that I just wanted to review with you on is Proposition 15. Now, let's see, this Proposition 15, people say, oh, isn't that a commercial thing? It affects office spaces and businesses, but not any residential property types. Please know that it does affect multifamily units that are valued over $3 million, and it will reassess property values of those properties. So it's definitely an important proposition that we encourage you to look into and vote no on. So I think we see Henry, welcome. So please pay attention to Proposition 15. Prop 19 is one that CAR wrote and is put on the ballot for this year. This is the property tax portability initiative, where if you're 55 or over, you're able to move your property tax base, your original old property tax base, 3 times to any county in the state. Now, before, you were only allowed to move it from certain county to certain counties, and you could not purchase a property that was priced more than the property you're living in. Now, with this initiative, you are able to purchase a property at a higher value. You would pay the full property tax base for that higher value, but anything under that, you would be able to move your original property tax base. This is something that we think is really important. If you're a fire victim, if you're severely disabled, you'll also be able to have this. It does maintain and keep, if you're inheriting a property and you're living in it, you still will be able to keep your original property tax base. However, the only change that's happening is if you're inheriting a property and you're not living in the property tax basis will reassess. So overall, we think it's a great ballot measure. CAR was getting wind that a lot of the legislators were planning on removing completely the whole parent to child or parent to grandchild inheritance transfer property tax base. So this ballot measure will protect at least the people who are living in the properties that they're getting inherited, and will maintain that. So please take a look at that. And then again, Prop 21 is very similar to last year's Prop 10. That's a rent control measure. And this would completely eliminate vacancy decontrol for a lot of our units. It would also put single family and condos into our rent control rules if they're owned in a trust or a partnership, or if you own 2 single family homes or more, they would be falling under the rent control rules as well. So vacancy decontrol, again, is if you are happening to rent a place for $1,000, it's been under rent control for 10 years, and then all of a sudden your tenant moves out and you can relist your property for rent at whatever price you feel is fair, whatever someone's willing to pay. Maybe the value now is $3,000 a month. You'll be able to now lease it at the market value. This proposition would eliminate that and put rental caps on how high you could go. So the cap for this would be 15%. And it could be less in some cases. So if you had a property that was renting for $1,000 a month, and you can increase it by 15%, that only brings you up to $1,150, and your market rate's $3,000. So who gets that unit at way below market rent? It could be anyone. So it just doesn't make sense. It's taking rent control too far. We already have a statewide rent control bill that was signed into effect in January. That we feel is strict enough and people are dealing with fine, but this is just way too far. So if you're not familiar with 21, please check that out, and we're encouraging people to vote no on that. So that's a quick wrap up. We have about a 45-minute version of what I just said on our YouTube channel as well. So if you really want to hear all the details and the history of these propositions, check out that YouTube video before you make your decision to vote, and help us spread the word as well. So with that being said, I'd like to pass it on to our commercial director, Will Tiao. He's an amazing agent, does amazing business with residential and multifamily. He has his own tenant-in-common property that he's working on, or part investor, and you can explain that. He's our commercial division director. He's an investor, great resource. So I'd like to turn it over to Will.
Thanks, Anthony. Hey, everybody. Good to see you guys again. Welcome back to the LA Multifamily Investor Networking Group. Really excited to have our guest speaker today, Henry Jeans from Sterling Bank. But before I hand it over to Henry, you know, we always do kind of a little bit of a market update and throw it open to all of you guys who are out there. You know, if you have any off-market properties or on-market properties that you guys want to discuss and talk about, this is a great forum for it. We've definitely done deals in this forum. You know, the multifamily market is, you know, like every, you know, all the different markets. I would say the biggest question I get, right, because you know, we're brokers, you know, we're agents. We primarily deal with multifamily. We also have a property management side, TIC Properties. We manage a few hundred units. And probably the number one question I get regarding multifamily is, what's your collection rate like? Like how are collections going? And, you know, what's been very interesting is that throughout the pandemic, you know, obviously the biggest concern for most multifamily owners right now is the eviction moratoriums, right? There's major concern that, you know, and understandably so, obviously, right, with everything that's going on, that there's a lot of concern about being able to collect rents. And but what's interesting is that, you know, through the pandemic, we've been at about a 90 to 92% collection rate during this entire period. And I would say in the last month or two, that collection rate has actually increased to like 95 or 96%, which says to me that multifamily is still one of the safer plays out there. You know, I know that there's a lot of concern about buying in California, and that's, you know, it's understandably so. There's a lot of concern about regulation and, you know, Prop 21 that Anthony just talked about. But at the end of the day, you know, most of our clients are doing quite well. I will say that, you know, depending on the asset class that you own, you know, that could depend what your rent collection could be like. For example, I would say if you own a Class A property in downtown or mid-Wilshire, yeah, that could be difficult because there's been an oversupply of those. We manage a luxury condo downtown. We had to give away 3 months free rent in order to get that one rented. I would say that our B and C class properties, you know, there have been some concessions, you know, 2 weeks rent here, 1 month rent there. But I would say frankly, the lower down the scale you go, down B, C, almost D class, like the less that has actually happened and the less it's happened in terms of rent decreases. So, so it's just something to consider as you're, you know, looking at potentially purchasing or selling your multifamily investment. So as Anthony said, one of the main reasons we have Henry here and why we're so excited to be talking about TICs and TIC financing is because we have a TIC, a Tennent-in-Common deal that's coming up in West Hollywood. We believe, and Henry can help me verify this or not, we believe it's going to be the largest TIC sale in West Hollywood. It's an 8-unit property. It was a multifamily property. We have now taken those units off the market, and we are going to be selling each of those units as a TIC. And I'm going to share my screen now so you guys can take a look at what we're doing there. Can you all see the Hayworth? Awesome. Okay, so this is the Hayworth in, it's the address is 127 North Hayworth. It's between Hayworth, between Fountain and Santa Monica. This is the aerial view of the property. Side view, as you can see, there's a large private courtyard. There's actually two sections to it. This is a private yard just for that front unit. You know, we are in construction right now. We expect to have these units available in the next 3 or 4 weeks. There are 8 units. They're all 2-bedroom, 1.5 bath townhomes. This is a rendering of what it will look like when we're finished with the units. You know, they all have that kind of old. We've tried to keep that old Hollywood style, but updated it. And this is actually a finished bathroom. Those were renderings. This was actually a finished bathroom. So that gives you a sense of what they're going to look like. They're all going to be about 1,200 square feet, and our starting price is going to be around $725, depending on the unit. So we're very, very excited to be sharing these. We expect Sterling Bank will be one of, if not the main financial component to this. And it's very important, I think, for everybody to understand, whether you're an agent, a potential buyer, or if you're a multifamily owner thinking about getting out of the multifamily game, converting your units into tenants in common could be one of the exit strategies out. And a critical part of this is the financing for TIC owners. And that's what our guest speaker, Henry Jeans of Sterling Bank, is going to be talking to us today. So Henry, I turn it over to you.
Can you hear me?
Yes.
All right. Great. Well, thank you, Will. I appreciate the opportunity here. My name is Henry Jeans. I've been with Sterling Bank and I'm sorry for all the technical difficulties. We might need to have Will also help share the presentation that we put together, so all of this will make more sense. But I appreciate the opportunity to be here. And normally Andy Serkin is, it's not easy to follow in Andy Serkin's footsteps, but in this case, this is one of the times when it's very good to follow Andy because he obviously helped lay the groundwork really for what tenancy in common is, what it means, how it breaks down. And it's always kind of good to get his perspective on things and kind of get his explanation as to kind of legally how this all works. I've been in San Francisco for the last 15 years with Sterling Bank, and but came down the TIC market for many years, going back to 2009, was very, very quiet here in Los Angeles. There was maybe a few parties who were kind of thinking of converting a building. And then we abruptly lost our ability in Southern California around 2010 when the bank was consolidating. So we weren't able to do anything. And I think the TIC market kind of had to take a break. We came back into the Los Angeles market pretty strongly then around 2013 or 14. And we now have 6 branches here in addition to the 25, 26 we have in Northern California and also New York. And so around 2016, 2017, I think parties again began kind of looking at the tenancy in common model. And in 2017 is when it really began to take off, sort of in the model, in the way that it was intended to, the way it certainly has taken off in San Francisco. And by the end of this presentation, I'll just try to give you a sense, but if you're not already aware, I mean, Will's timing with this Hayworth property is very good right now. The market is very hot right now and very kind of open to tenancy in common. It's been maybe a couple of years now that there's been an active amount of listings and people have kind of been kicking the tires, understanding the TIC concept, but people really now are beginning to see that, okay, there is a pretty firm legal backing here with the ownership of what you're buying, what exactly it is that you're getting a loan secured to. And I think the Los Angeles community, real estate wise and otherwise, is getting pretty comfortable with this form of ownership. And it certainly is doing what it does, and that is sort of helps refresh properties, helps basically get recreative with multi-unit properties and expands options for property owners with these types of properties. And Will's property on Hayworth is a perfect example. It's a way to go in. These units are now going to be updated, and the value will certainly be there. And it's going to basically provide something in a, in a great location, but something on the market that may not exist otherwise, in a neighborhood that people want to be in at a price point that people are comfortable with. That's really sort of the unique angle that Tenancy-in-Common can create for property ownership when everything kind of lines up. So let me start. I'm going to go through, I guess we'll maybe go to the next slide. I mean, so kind of going through what Andy, and that's me, and we have 6 branches down here. The next slide, there's our headquarters in Southfield, Michigan from way back when. The bank came to California in the early 90s, mid 90s, and really began to grow solidly in California. And as you can see, we've got about 20 branches in those locations up in Northern California. We've got 6 branches here in Southern California, and in the Arcadia branch as we speak. And there's a branch in Bellevue and Michigan and in New York as well. So we are a publicly traded bank right now with around 30 branches. And Tenancy-in-Common is one of the main programs that we do offer as a residential program. It was very important for Andy to kind of go over the history of how did Tenancy-in-Common get legally to where it is in this current status in the state of California. And he basically did touch on that really essentially since the mid 80s, later 80s, there were lawsuits challenging this form of ownership that arose in many different parts, certainly starting up in San Francisco. And basically, as Andy kind of summarized, that they all led to sort of consistent decisions by the state courts that effectively they're not going to get into the business of managing co-ownership of real estate. And basically, if 2 unrelated individuals want to go into co-ownership through a private agreement, they are not going to legislate that or regulate it. It becomes, obviously a very murky can of worms to do that, and they realize. So I think the decisions from all the various court levels, culminating in 2004, I think with the state appellate court in the north of part of California, really basically came down on the side of property owners as far as forming tenancy-in-common ownership interests and managing through a private agreement. And so that's where we're at now. What's so important about 2004, I wasn't yet with Sterling, I was doing mortgages in a former life, but is that paved the way for the current financing environment that we have, which basically started in around 2005, and that is fractional tenancy and loans coming out and emerging as an alternative to the otherwise only available group loan format. And the first fractional loans basically came out in 2005, and then in 2006, I think Sterling got into this in around 2006. I joined the bank in later 2007, and they already had the program in place. And there was maybe 7 or 8 other banks in San Francisco that also had done that. Banks basically kind of entered this market realizing, or back then realized that, okay, so, the rights of individuals are protected here through this TIC agreement. The state is not going to come down and sort of try to reassign these rights. They've made it clear where they stand. I think we're comfortable now basically with a loan that is secured to this exclusive right to occupy. And so that is kind of where residentially, where the financing piece starts in terms of what these loans are. How do you get a loan secured to just part of a building and not the other parts of the building? And that's what a fractional tenancy and loan can do. Effectively, each loan becomes its own first lien status within the parcel against that exclusive right to occupy. So in other words, you've got an agreement, everyone has their exclusive occupancy percentages, their undivided percentages, and the mortgage is then secured to just that individual unit. So you take the parameters of what the unit is worth, what the borrower's qualifications are, anything else you need to know, and you're really going to begin to approach financing within these TIC communities as if they were essentially condominium communities. And that is really was kind of the goal with this, and largely how it has worked out over the years. So, you know, starting, I guess, from the top here, I mean, tenancy-in-common being kind of a, you know, a long-standing way of holding title for unrelated individuals within buildings. That's what this is based on. Ownership is going to be divided into any number of interest percentages, and then basically going down the list here to the liens, co-owners and interest percentages are not subject to the liens of other co-owners. So now this works when every part of it works. An important part of this is, of course, that creditors have rights within these buildings. And that is spelled out very clearly. Andy, over the years, has worked, you know, I think these TIC agreements from when he started putting this together in 85, 86 or so have really matured and come a long way through different scenarios, through different lawsuits, what have you, scenarios that have come up to better protect co-owners, to better protect co-tenants, as they're called. So basically, parties within a tenancy-in-common building are referred to as co-tenants. Of course, lender protection language has had to evolve over the years, and it has. And so that is really what helps basically kind of keep this together. Now, an important part of this is, of course, the title insurance component. You need to be able to have protection for your property, for any kind of encroachments on title, and you need protection for that. So anyone who's, you know, able to encroach on title or place a lien on your private or on your title, or basically encroach on your property, you need title insurance. And that piece of the puzzle has also effectively been solved. There are certainly enough title companies right now, although not everyone is familiar with it. They are more and more becoming familiar with it, and as well down here, that basically offer single policies just against these exclusive occupancy percentages. So what you're left with is effectively a building. In this case, let's take Will's building on Hayworth. There's 8 units in there, if I'm not mistaken, correct, Will? And
yes, that's correct. Sorry. Yes, I was muted.
Okay.
There's 8 units.
And you'll have the ability, you'll have 8 different liens that will be on this building. They will all be independent, and they will effectively be first lien mortgages secured to the exclusive percentages. It doesn't matter how big or small the percentages are. I'm willing to bet that in the case of Hayworth, the various different undivided percentages are different across the units in terms of size and amenities. Correct me if I'm wrong, Will.
No, that's correct.
And yeah, so, but it doesn't matter because the smaller percentages will be worth less. They'll obviously go into contract for less. And so you just have a sort of a different size of property that you're working with versus a larger one. And that doesn't matter. It allows for everything to effectively be kept independent. It allows for borrowers to be separate from one another in terms of mortgage obligations and anything adverse that can happen. So if your neighbor, for example, I'm going to kind of go through, get caught up here on the presentation. Let's maybe go to the next slide on this. If your neighbor defaults on their fractional loan, misses a monthly payment, for example, you don't know about that. No one else in the building is impacted by that or really would have any idea about that, at least not directly. So that is truly what makes this work. So you're not at the mercy of someone else, even though you are co-owning property, you have truly separate mortgages. We can talk a lot about what happens when someone does default. Of course, if someone is having difficulty making their mortgage payment, all of a sudden they lose their job and they are not able to make a payment, they're probably going to have other payment issues as well, and they may not be able to make their HOA payment. That, of course, would be the first sign of when maybe the building knows and the HOA knows that this person is in financial trouble. Oftentimes people are going to ask when, what happens if someone doesn't make their mortgage payment? Well, technically nothing if they can get it resolved quickly. But it's usually followed by someone not making an HOA payment or a building obligation in some other way. And then the HOA is obviously impacted, all the co-tenants are impacted, and that borrower is effectively in arrears for their payment and basically in default of the TIC agreement in terms of their obligations spelled out within the TIC agreement. So I don't want to go down that road too much of what can happen. We can talk about that later. But let's see here. What's important to know about this in terms of the key documents that Andy was going through, what counts, what allows this process to work and what doesn't. Well, what Andy was talking about is what allows this process to work is to, first of all, not violate the Subdivisions Land Act, the state law that basically prohibits subdivisions unless it's allowed of condominiums. So you can't just go begin subdividing your own building. And you would do that if you inadvertently recorded a document that had a unit number on it or an individual address within a building. So that is one key. So the grant deed is obviously a very key document within the mortgage process that must clearly not reference units, but just the percentages. So you're going to still have one grant deed in a tenancy-in-common building in a fractional loan scenario, but you're going to have, let's take a simpler building, for example, in Hayworth. But Hayworth should, for example, have 8 potentially different owners listed on the grant deed and their percentages. A 4-unit building would have 4 and their undivided interests. In other words, I should use that term instead of percentages, because undivided interest sounds like an oxymoron, but that's exactly what these are. And so on and so forth. So that's the key distinction here, because everyone says, well, but the TIC agreement is recorded. And as Andy was saying, the TIC agreement is not recorded itself. That is the private document that spells out all of the rules and obligations within the TIC. But the existence of the TIC agreement is a recorded document. And that is the addendum. I have one of these here. That announces to the world that there is a tenancy-in-common ownership. And I'm sorry, that's a declaration here that goes along with every TIC agreement. And it announces to the world, to creditors, to anyone who needs to know that there is, in fact, a tenancy-in-common ownership in exists in a private agreement on this building. So that is one key item to understand. Still, I'm going to kind of repeat some of the stuff Andy said because it's really important for how this works. And as long as that is the case, then there really won't be any issue. There's no issues with subdivision. And, you know, as Andy's explained here. So let me go to the next slide. I think the next slide goes over rates. And I'll get into now a little bit of the heart of what we do here. So in the 15 years that I've been with Sterling, effectively since I think fractional loans have come out, it has been characterized as an ARM-based market. And I think most of you might have heard that by now. We are not yet at a point in time where there is a 30-year fixed option, a 15-year fixed option. Several banks do have a 10-1 option, and we're having discussions about that as well. But beyond that, it is largely an ARM-based market, and that is the first thing clients need to be aware of. And if any of you realtors and are showing interested clients in TICs, that is sort of one of the first points to touch on, that you do need to be comfortable, the client needs to be comfortable being in an ARM. For some people, that is automatically, that's fine. And for other people, that's an automatic, just no, not going to happen. So it does sort of touch a personal nerve in terms of financing comfort. And so what you get is, and I've seen this over the years, it seems time and time again, buyers, potential people on the market right now looking at properties, they stumble across a TIC and they walk in the door and they love it. Almost universally, this is the case. They say, this is amazing. It's refreshing. This is just a nice new, look here. I like the price point. I like the neighborhood. And then they learn that the financing is ARM-based. And at that point, maybe, a certain percentage, maybe half or so, they turn around. That's too much. They can't handle being in an ARM and they walk out. But the other half say, I don't care. I love this unit. I love this location. I love everything about it. And they move forward. And this is typically sort of how the market, how the buying public comes, when they come in contact with the TIC, this is kind of the normal reaction. Now in San Francisco, there's large acceptance for TICs. The whole city essentially is very familiar with them. They're a very significant niche within the real estate market, and people are aware of this. So, and I think more and more people are comfortable with ARMs there. They seem to be, because they understand the value of the property. Fundamentally, we're still slightly early days, you could say, in Los Angeles in terms of, numbers of on the market and really what their track record is as far as appreciation goes. I mean, we've really only had an active market here for about 2.5 years. And so it's too hard to gauge that. But I can tell you in San Francisco, the properties up there, the Tennent-in-Common units have completely kept pace with the rate of the market values increasing. And anyone who bought in a TIC, however many years ago, maybe they bought at a slight discount to the market, they've now appreciated in equal measure to where the market's gone. And now maybe they're at a slight discount to the very top of the market relative to where they bought, but they didn't miss out on any of the market. So these properties right now really do tend to move with property values in general. These are not sort of viewed as some other class that, maybe doesn't move quite as much with the market, or you don't quite gain as much equity. That's really not the case with TICs. So that's also important for the buying public to know that these are basically very relatively liquid and definitely market tracking types of properties here.
Henry,
yes.
maybe you're going to answer this, but I know you have rates on there, and that's always a question that our buyers are asking. Approximately how much higher are the rates for TIC loans over a regular like 30-year fixed?
So good question. Let's dig into the rates right now, because this is kind of what the rates look like. As you're seeing across the board here, we're basically between 3.25 to 3.75. I can tell you just sort of anecdotally, the 5.5 CMT arm is probably the most sort of preferred out of all of these once you kind of sort through the options with borrowers due to the 225 cap structure. So it has a very limited or slower moving sort of adjustment process to it. And how these rates compare right now to, say, Fannie Mae conventional arms on the market right now, I think you'd find, to be honest with you, it's a good question. I don't know today. I think you'll find these are generally 1% higher, maybe 0.75 to 1% higher than the market. That has always kind of been the standard delta between where TIC rates are and the market. So you're generally about 0.75 to 1% higher than what you'd get for an equivalent arm. But we have lowered these. I've watched these rates come down steadily for about the last 12 years to where we're in this mid 3s right now. So they're about as solidly as low as they've ever been. I don't know if we can go much lower here. This is a kind of a crazy interest rate environment time that we're in. But that's about what the difference is. So it's not a big difference. If someone's very rate sensitive and they're shopping and they may then say, well, that's, TIC rates are 0.75, that rate's, 7/8 higher, 1% higher. But most people see the value sort of inherent in the property and all the other it's sort of attributing factors and value within these TIC units that they're often willing to say, okay, I understand the rates are a little higher and it's an ARM, I'm okay with that. So that's generally how this proceeds. I would say buyers should have a sense of where interest rates are going, or at least some kind of feeling for the rate environment that we're in right now. We are in a low rate environment. It seems like it's going to stay here for a while. I mean, no one has a crystal ball, but at the moment, things seem to be staying pretty low. So this seems relatively stable at the moment. Now, any kind of, I think, global shock or event could change things overnight, but we seem to be in a longer term pattern as far as low rates go that I didn't think would be here this long. And so I think that has also been to the benefit of TIC owners, certainly ARM holders in general. But it has certainly helped the TIC market over these years.
And Henry, could you talk about the down payments?
Yes. So down payment. So Sterling is generally right now, we are across the board at 80% on all programs, and we can go up to 90% loan to value on loan amounts up to $850,000. So that would support a purchase price of close to say $944,000. So we are right now we're able to basically go as high as 90%. The 90% program, once you cross the line from 80 to 90, you will incur mortgage insurance. So there's private mortgage insurance on that. The payments are relatively nominal. I mean, if I do a 90%, if I price a 90% PMI rate quote, it's going to maybe be around $140, $150 a month. So pretty reasonable. Historically, we had not done a lot on our private mortgage insurance program in San Francisco, and because the price points and the borrowers just, wasn't needed, but it has been exceedingly popular and in use since we've come down to LA around 3 years ago. We are getting a lot of people with just 10% down is what they have available, plus reserves. And I'll talk about our reserve levels and closing costs. And so it has put a lot of people into homes, into TICs across Los Angeles in the last 3 years that would not have been able to get into a unit if they'd been going with another lender, or had we not had this. We are the only lender who has any kind of private mortgage insurance option with its fractional TIC program. Let's see here. Our loan sizes do go up quite a bit. They're kind of more San Franciscoized. We do go up to 3 million as far as the loan amount goes, which I don't think we're quite there yet. Will's property on Hayworth is going to be pretty pioneering, but we're not to the $3 million mark yet in Los Angeles. I think we have not seen anything really. We're getting into the high 800s and 900s now on some units. But we do go that high. That's not an uncommon amount for TIC in San Francisco. There are quite a number that are at least in the 2 million range on a regular basis, as another example of property prices going up there. Reserves on these. So closing costs and reserves, borrowers should be prepared, generally speaking, they need anywhere from, it depends. Will, give me a sample size, purchase size on Hayworth, for example. 800,000 would be one, or
that's about right.
Yeah.
Yeah.
So they would have. So someone steps up. They're going to buy something for 800,000. They're going to get an 80% loan at 640,000. Closing costs will come down to. We're going to have about 1,100 for our underwriting and processing. There'll be an appraisal and other third-party fees that will be about another 1,000. And then you'll have title and escrow on this for around 3 or 4,500. One of the closing costs that will factor in is whether or not you choose a rate that is a 0-point rate, a 0.5 point rate, or a 1-point rate. So in other words, 1 point origination will give you our lowest rate possible. And then there's a 0.5 point option and a 0-point option on this. So all of that will factor into closing costs. And then on top of that, there'll be recurring closing costs. But for example, in this transaction, 640,000, I would say there's going to be somewhere, if you did 0 points, you're going to be looking at around 6 to 8 to 9 to 10,000 or so in terms of closing costs. And then reserves for the borrower are going to be at least 6 months full payment equivalent for a primary residence. So they'll need to verify after everything's accounted for that the borrowers still have 6 months full payment equivalent in the bank. It doesn't have to be liquid. In other words, in cash form, it can actually still be in remaining stocks or shares that they didn't liquidate. Those are taken then at an adjusted value, but those are fine. We can use those too. But they do need that as well. They cannot kind of just come into a TIC with their last month's rent or their last, sort of month of reserve and use that. They're going to need to have some cushion afterwards. We do work with gifts. We do see a lot of gifts happening now in purchases from family members. That is quite a common occurrence, and that's fine. we can have most of the down payment, most of the entirety can be gifted, but borrowers will still need to have at least 5% equity in the entire transaction of their own funds. So they can't really step into a TIC purchase with nothing in the bank and have everything gifted to them in terms of closing costs, down payment, and reserves. That doesn't work. But we do see gifts playing a bigger and bigger role as property values do what they do. So that is that's quite a common format as well. Go back a second. Let's see here. Yeah, I just want to go to this, and then I'm going to go to a few slides. And some of these slides I've not updated since last year, so I'll kind of go through the changes that I've seen in the market. Let's see, last but not least here. Okay, so I think I went through closing costs. There is a banking relationship requirement with Sterling that most borrowers will want to sign up for, because it will basically ensure that they will get the best rate in the process, our lowest rate for any of the ARM groups they're choosing. And essentially, we do have most borrowers go through the banking relationship. They'll establish their bank account in our Koreatown branch, and that has been pretty successfully the practice for the last few years. And I already went through mortgage insurance here and closing costs. There is also let me just talk quickly about TIC agreement review with our loans. You're going to, so in other words, Andy Serkin is going to be enlisted, engaged to prepare the TIC agreement, but we need to then review it ourselves, and we have our own counsel who will review the TIC agreement kind of more towards the end of the underwriting process, and there is a $350 fee for that. Borrowers sometimes get confused and they say, well, I already talked to the attorney about this. That's a separate fee for our attorney to review the TIC agreement to make sure that the borrowers are added on properly, that the agreement is up to date with all the lender protection language needed, that we're not getting some kind of old agreement that doesn't protect us. And, you know, should there ever be a case of litigation, and Andy started to touch on a lot of this stuff last week, non-judicial foreclosure and things like this that get involved, but this is where you're going to want to make sure the TIC agreement within a community is as up to date as possible, is signed by everybody, and most importantly is that it's kept track of within the HOA, and anytime there's a change, the HOA is aware of it. The assumption release or the transfer documents are available, and because the tenancy-in-common agreement really is a living document, so to speak. It is constantly evolving as the ownership in the building evolves, and as there's maybe any changes or decisions by the HOA for this, that, or the other thing that needs to be addressed. Rules about pets, rules about this, rules about who knows what. And so it is really important, and I think this is happening very well down here in Los Angeles, to be quite honest. As the market has started just 2.5 years ago, Los Angeles really has had the benefit of really everything kind of being in place now, in terms of, certainly in terms of TIC agreements, in terms of getting legal advice, and in terms of advice to buildings and how to manage their HOA. So what we see in Northern California sometimes is a little bit different. It's a little bit the older way. People are not always quite on top of documents. We do see times when they cannot locate documents, and this is kind of the norm we've seen up there. So we do stress that how important it is, should there be a legal issue, that, you know, the only thing the building itself has to stand on is its TIC agreement, and it needs to make sure that everything is up to date and executed. So we do require that at the end of all our loan closings to make sure everything is buttoned up as closely as possible. So I'm gonna just, okay, so let's, I guess that covers, I think, unless there's some questions or anything that maybe that I missed, that kind of covers the basics on the financing. It really is not too complicated or too that different than standard financing in a lot of ways. There are scenarios I will go through. I know there's a lot of developers on this call, presuming, and there's a scenario that will happen quite frequently whereby you have, say, a 4-unit building, and you've got a $1.3 million loan on the building, or let's say you've got a $900,000 loan on the building, and you're going to sell the first unit for $500,000. You are going to get those proceeds, but you then have a remaining $400,000 balance on that outstanding lien that is secured to the entire parcel. Yet our fractional loan is trying to come in and say, hey, we're coming in and we're going to be here in first position on that unit upstairs. But we don't have that right yet until the existing lender, because they're in first position, either agrees, one, to reconvey that $400,000 balance and secure it to the newly established undivided percentages, or, as occurs in most cases, they say, no, sorry, we're not going to do that, and you just need to pay us off entirely. In which case the developer then has to evaluate, okay, can I refinance this? Do I have 400,000, or do I need to sell the second unit across the hallway, and then I'll get another 500,000, and then I can sell both? The latter C is what happens most of the time, is that another unit has to be sold. It is difficult to get banks to reconvey unless there is a very creative lender. We used to have it on our commercial side, and we hopefully will get it back. I think there are some hard money lenders that are participating in the market that have that feature as well. But it will come into play depending on the size of the project and the existing finances at play. So let me see here. So I think I covered all the basics. And I think what I just wanted now, maybe we'll go into let me see here. I don't know if you want to go back in this slideshow, and I'm going to kind of just describe sort of where TICs have started. Basically, yeah, there we go. And this is an old map already. I put this slide in a year and a half ago, and I've really wanted to update it because this doesn't really begin to now even capture where things are now, as opposed to where they were then. But I think everyone kind of gets the gist. Northeast Los Angeles has been sort of ground zero for property conversions, TIC conversions. There's just so many unique and characteristic 3, 4, 5 unit buildings. And that with a little bit of work, a little bit of renovation that maybe the building hasn't seen in a while, suddenly turn into 4 very desirable units. A little bit of history here. I think the real first successful fractional TIC conversion happened on Sanborn. And let's see here. I'm trying to remember what the block was, either 400 Sanborn but it's right there in Northeast, right in Echo Park. And the units did exceedingly well, and it really created new spaces at price points that people were not expecting. And it basically got first-time home buyers into units where I don't think they thought they even had a chance of buying. This is definitely the recurring trend here. And I think it's going to be the same for the property in Hayworth as it is in most cases. Even if price points vary, you are going to create something, establish something that, in terms of dollars per square feet, is going to be more valuable than an equivalent condominium, or certainly maybe what they can find in single family houses. And that's going to be the allure here with this. So kind of in line with that, the sum of the parts is going to be worth more than the whole. When these buildings are sort of creatively updated, this is what happens, and almost in every case. This map here now is really filling out. There's one little dot near where Will's property is going to be. That property, I think, was on Genesee, and that was a successful closing. I think there was recently a TIC community that closed on Waring Street, which I think is in West Hollywood proper. But there isn't much yet there, except a few things. But there's definitely been a lot more filling out here in the Mid-City area. And the activity along in Santa Monica and along there, and even between there, has vastly grown. I mean, there should maybe be 20 more of these red circles here, and the property list goes on and on. So this is sort of an idea. And then I guess if we go to the next slide here, the point of these is to kind of get a sense here of just what lends itself well to a TIC conversion. Will's building is very impressive for one. It's important to note that he is doing an 8-unit building, so it's definitely an ambitious project. There is a public report process that they have to go through, because any TIC conversion, as Andy was saying, larger than 4 units, you need to get a public report to allow for that conversion, which can cost the better part of $25,000 between state and attorney fees. But it will create something that, you know, a larger building that will have value. Now, going through some of these properties here, this is a 4-unit right here in, let's see here, this is right in the center of town, near Hancock Park. And this was a 4-unit building. So very simple conversion. If you want to start simply in the tenancy-in-common market, you want to start with 4 units and less, because there is no public report needed. And you're basically just getting a TIC agreement through Andy, or Lisa Paul's another one of the established attorneys in San Francisco who are doing these right now. And then you're basically ready to sell and market. There are no limitations on you being able to market a share here. And so this is one in Hancock Park. Let's kind of go through here to these. This is another one this one's in Silver Lake right here on Marcia. And again, took this apartment complex and really basically gave it a new look. And I mean, I'm telling you, people were besides themselves when they discovered this unit. I think this was last year. This was on the market. And going through here, there's some other ones here. For example, the next one here is on Newland, and this created some nice backyard space. The key with these projects is there's obviously no shortage of multi-unit buildings around, but to give this a successful touch, any tenancy-in-common conversion, one key is to be able to sort of carve out or create exclusive use common areas. That's an important part of what constitutes part of the undivided interest. So in other words, everybody, when they buy their own property, you know, they're going to want a little bit of their own privacy, maybe their own deck, maybe their own backyard, maybe their own side area that is just them. To the extent that these spaces may exist or may not exist, or can be created or need to sort of be incorporated into a design of a TIC conversion, they are truly important. They are what make sort of the TIC give it that final sort of homey feeling, and give it that real final value that says, yeah, this is a real residence. This has unique characteristics to it, and it really gets that buyer to say, okay, you know, there's just some private space here. Even if this is, say, $375,000, you know, I've got yard space here. And so it's putting some thought into the exclusive use area component in any TIC conversion is really important. In San Francisco, a lot of the buildings are kind of up down, you know, multi-unit buildings stacked on top of each other. So it comes more down to views sometimes, to be quite honest with you, that people get, you know, that people can, you know, they go for, and that where the value comes out. In Los Angeles, the property mix, to be honest with you, in my opinion, is even better suited to being tenancy-in-common ownership than what we're used to in San Francisco, because there are so many more buildings with more space around them. And furthermore, it's because there are also so many detached bungalow style properties that for those that are still around, and there are a lot, you know, allow for there to be multiple independent homes on one parcel. Again, the parcel has always been there. It's always been one APN, but, you know, the number of unique bungalow properties on parcels, there's a lot of them around Los Angeles, and that doesn't really exist so much up in San Francisco. And these type of properties have really been successful conversions, and in my opinion, really one of the sort of great features of Los Angeles tenancy-in-common market is what you can do with some of the properties down here, as far as, you know, having them fit into the TIC mold, creating these exclusive spaces, and really creating spaces where people want to live that, you know, there isn't really an equivalent for in the market at the same price point. And if we go here on the next one, let's see, so that was one right on Wellington, West Adams. And the next one here is on Melrose. So that, I believe, were detached homes there on Melrose. This is one now. This has already been about 1.5 years, 2 years back. This is another one in Edgware. I think there's been even a resale in Edgware already. This is one of the original TICs, beautiful building up there on Angelino Heights. And, you know, people are now looking closely, and I'll talk about this one in Glassell Park soon, because that's a really great bungalow property example. People talk a lot about, okay, well, you know, the TIC market, I mean, can I resell these? How am I going to resell my property in any number of years? I mean, what is the resale value with this? And that's a legitimate point of concern that I hear. This one on Edgware is one of the first resales that we've had. This one on Glassell Park now, I think there's going to be a resale. Yeah, that one right there in Edgware. And now happening here in Glassell Park on this one on Avenue 33, where those are 7 bungalows. Well, they're bigger than bungalows. They're really basically like nice homes, mini established homes. This picture doesn't quite do the whole entire lot justice. Shows that one house very well. But they were built in the mid-20s. These were basically bungalows housing created for, you know, Hollywood workers. And over the years, the property, of course, kind of fell into disrepair. I saw it in early 2017 when it was really not looking so great, and had, you know, basically kind of been run into the ground over the years through renting and just neglect. And the owner was just ready to do something. She essentially at that point discovered that, well, first of all, condominium conversion was going to be extremely complicated, and the tenancy-in-common conversion was probably going to be much more realistic, much quicker, and much more cost effective. And sure enough, these properties are beautiful now. I think there is one on the market right now. I don't think it's this specific unit, but that's another example of a resale. And so resales are hitting the market. And, you know, what I tell people is that, you know, resales are effectively going to be treated the same as new properties would be on the market. What's the interest level in general right now? You're going to find the same interest in established TIC community. And to be quite honest, you've already got an established TIC community operating with an HOA. It's a very easy proposition to move in once you are in an established TIC community. So if you're trying to sell your unit, but you have a well-functioning HOA and you've got, you know, just kind of everyone knows each other now, gets along, you've kind of really established that it's not going to be difficult. The property will sell itself at that point. You know, you're going to have maybe some of the usual objections to TIC ownership, and, you know, maybe dad's contributing to a child's down payment, and then the parents have concerns. But for the most part, you're going to find these communities run themselves extremely well. There is almost an additional incentive without the lack of regulation that you have in condominiums over budget items and what have you, because you don't have that with TICs. It's just up to the tenancy-in-common, to the co-tenants to manage. It almost creates an additional level of incentive to do things as perfectly and as sort of cleanly as possible, and so that there are no issues with finances, there are no late payments. People do not want to jeopardize their ownership. They don't want to jeopardize the value of their tenancy-in-common, and having a strong functioning HOA is one of the main ways to do that. And as a result, I mean, 99% of communities are run as efficiently as they can. A lot of the communities down in Los Angeles now are getting set up with a account managing group. So there are a couple private individuals who will manage the books for co-tenants for buildings. And I think once you get into a multi, 3-4 unit building here, this one on Parkview was actually another beautiful building. The 2 units there that you're looking at, and there was a detached building in the back that you don't see that was even neater than these, that sold by itself. And so that really kind of was a really great property, and people looking at that were just very grateful, very excited to find something that, in the part of town where they wanted to be, in a beautiful building at price points lower than virtually every condo out there, and certainly, single family house offerings, if they wanted to stay relatively kind of, and that's the same part of town.
Henry, I just wanted to chime in for 1 second. I mean, I know one thing that clients have said to me is, exactly what you've been talking about. Will we be able to resell this property later? And, my answer is like similar to everything you said, but tenancy in common properties usually are priced a little bit below the market. That's our biggest marketing tool, is the price. So you're getting so much more exposure when you're marketing at a lower than, what the average price would be for the area. And then you're going to filter out who's willing to buy that and go with the rates and go with the ARM loans and so on, or not. But because you have that lower price point, slightly lower, you're going to be attracting so many people to see it just because of that. So, we don't see like tenants in common properties sitting on the market longer than other properties because of that. So,
yeah, no, I mean, it's definitely the case. The price points will draw people in. I mean, it will immediately catch so many people's attention when something's at 375 or 4, and they look at the square feet comparison to the value, to the price, and they double check, wait, is this correct? And absolutely. You have to then convert them, though. I mean, you're going to get a lot of interest. You're going to get a lot of interest from people who they're hearing about TICs for the very first time. And then once they digest all of the sort of the legal structure of it and how everyone's really just has to operate together, they may have their own hesitations. And that's where a little bit of the discount remains. Is that you're always going to have something where you're a percentage of a whole. Taxes are a shared obligation overall. So if there is a late tax payment, it affects the entire parcel. If there is an insurance policy issue, if there's somebody falls and sues the building, unfortunately, they're suing the entire parcel and the entire policy or HOA is impacted. So even with fractional financing, co-tenants really they need to recognize, and they do if they're serious by the time, that, there are still shared obligations. They are still connected at the hip, so to speak, with everyone regarding taxes and insurance. And these things have to be managed together. And if someone doesn't do it, it affects everybody. So it's always a process of, first of all, getting out in the market with, and showing the best property. But then you got to work through the scenarios with a lot of different potential buyers and agents. And it just takes, if it takes 2 parties to make an offer on a really nice condo, it might take 3 or 4 parties to come through and make a good offer on a TIC. But I can tell you those people are there. There's more of them every day. I mean, it's, right now is maybe a little slower, but the spring and summer was absolutely crazy in LA. And I've basically kind of come down here now. I'm the full-time manager in Los Angeles. So I'm managing stuff and keeping track of what's going on in LA now is what I do full-time in large part. And I mean, it was really crazy in the spring in terms of interest in some of these communities. So the interest is there across Los Angeles now. The model has shown that it can work. There's another great TIC over in Silver Lake on Berkeley. Unit came out in there recently. These were this is a drone shot, of course, of these 4 units that are kind of coming down the backside of the hill there on the top of Echo Park Drive. They were tremendous units. That when they came on the market about a year and a half ago. And, again, I need to update the slideshow for what's been going on this year. I haven't been doing enough, but there's so much here. There's the property on Sanborn that I was talking about, which is really kind of the first one to break the mold, so to speak, as I would say. Very successful. I think those at the time listed and sold in the 400s. For those units, and which was really, I think, a really good deal. And let's see, I see a question here, serviced by Sterling. So yeah, there's another one on North Rampart. To that question
about the Rampart, sorry to interrupt, Henry, the same developer that did Rampart also is doing Hayworth.
Oh, okay, I think you're right. Yep, that is exactly correct. Yep, that's right. So yeah, and it's, becoming a smaller town too in terms of the parties that know about these, and, everyone is kind of getting more familiar with this concept. I saw a question recently, and I apologize because I'm on my phone, so if I'm not seeing all the questions, maybe holler, but loans are serviced by Sterling. So these are true 100% portfolio loans, these fractional TIC loans. One thing that's important to know is that there is no secondary market for these loans yet at all. This is still considered a very niche, very, sort of, I don't want to call it inconsequential product, but not really big enough for the big banks or for Wall Street to say, hey, we're going to get a portfolio going of fractional TIC loans. That has not occurred yet. So we do service and manage everything ourselves. All the loans are on our books. I mean, our portfolio of San Francisco loans is enormous now. Hundreds and hundreds, maybe 1,000 by now, I don't even know. And we're now getting close to maybe 100 or more Los Angeles loans. But it is still an entirely in-house process. In terms of our processing and our underwriting, these are 100% manually underwritten files. It is a very exacting underwriting process. I will let you know now, warn everybody now. So we don't have the benefit of automated desktop underwriting, for example, for this. Click a button, yep, approve eligible, and then you just get a few conditions together. No, it is more exacting because we're keeping them on the books. But we service them all, and this is what we do. So we're pretty familiar with the process, and I think over the years have gotten together a pretty good process underway, despite all the challenges of COVID of late, which has seen us had to make a few changes. Okay, I just saw a question regarding full doc and stated, I think, and yes, these are 100% full income documentation programs. So definitely no stated income or alternative sort of documentation available here. We're going to go off of tax returns and pay stubs, be looking for income continuity. It's very easy. I mean, I could talk for a while about income in Los Angeles. 2 years of tax returns, not 3. But what's important is that if they are self-employed, this is Los Angeles, and we obviously have a lot of people in the entertainment industry who are self-employed, and it gets tricky. I won't lie, and I could have a whole nother separate talk just about that. But it is important to know that it is one of the challenges right now is showing continuity with income, especially for entertainment industry workers who have had productions, and then they don't have productions, and then there's a stoppage, and then it starts. So those kind of scenarios are still tough. If they're salaried, if they work for Netflix, that's great. If they have straight W-2s, or if they have an extremely consistent self-employed business and they've been reporting things very consistently for the last however many years on their tax returns, that's fine too. But we do see a lot of people who move from project to project to project. I see your question there on FICO scores, and I think what was the other question? FICO score is a good question. I don't know if that's the other one. 700 to 720 is the minimum levels needed, generally speaking. So self-employed up to 80% is 720, or it's 700 if it's 75% or less. We do allow for if a borrower has, for example, a credit score of 690 and they're putting 25% down, we will then, for example, evaluate compensating factors. Do they have 12 months of reserves? Do they have slightly lower ratios, or is there some other compensating factor? So we have ways of working with scores down as low as 680 when that can work out, but that's definitely the line in the sand. If someone has a score below 680, they have credit items that need to be addressed, and maybe we can work on those, but they're not eligible right out of the gate. Are there any other questions? There was another question there. I don't know if I got to it.
This is debt to income ratio.
Oh, yes, debt to income. 38% right now. Thank you. So across the board, 38%, but as I was saying, if they're putting 25% down, we can maybe look at getting that up to 43% debt to income ratio with compensating factors. But 43 is our line in the sand. Cash out refis, yes, we can do those up to 70% on any given property. There's a quarter add-on to the rate, and there's a max cash out of $500,000. If for some reason you've got a property where you can actually withdraw that much. But we do cash out refinances. We also do these on second homes. So this does work on second homes, but we do not do these on investment properties right now. And we're evaluating that program, but we don't have it. So if you want to, if you're a property owner and then you find a really affordable TIC in Santa Monica and you say that's a great rental, we cannot facilitate that right now unless you buy that all cash.
How many of the ones that you're seeing, and since you deal with so many, like how many of these properties do you see having have some type of rental restriction, like they've done an Ellis Act or something like that? Like how often are you seeing that?
Good question. I mean, I think it happens maybe every other property. It's hard to say. It varies. I don't always know or even ask. We ourselves don't have any restrictions on if a building has been Ellis, if tenants have been Ellis acted out or not. We will do the loan all the same. That's fine. But I would say it's definitely common. It can happen. It has unfortunately happened. I mean, when there's an Ellis in place, there's of course very serious rental restrictions. And so that is something that buyers need to be aware of, because there has been occurrence, unfortunately, where there was an Ellis acted tenancy in common, and then a co-tenant unknowingly or whatever did advertise a rental through Craigslist or what have you, maybe a year later, and that was not received well, and that got them into hot water. So that is explained pretty carefully when it's the situation, but it does have to be explained very carefully. It definitely is in place in a lot of TIC buildings, across Los Angeles.
Dave is asking, how much under the condo market is the sweet spot? 20% or is 10% enough?
Well, good question. We're seeing that delta shrink in certain neighborhoods. 20% is definitely a sweet spot. If you can identify a unit 20% or more discount over an equivalent condo, you're doing well. The average is understood to be around 10 to 15% as far as the discount. So if you take apples to apples to, or pear to apple, a TIC to a condo that are similar, you should expect at least a 15% discount. But we're seeing that shrink. It's hard to gauge that perfectly. For example, some of these TICs in Northeast Los Angeles, are done really well, are very attractive, and there was definitely overbidding going on. So that delta can definitely shrink. It depends also on the size of the property. I think once this market gets more into the $1 million range, and if we start getting $1.5 million TICs, you'll see that delta versus condos increase a little bit more. But in the smaller sizes that we're in right now, the $500,000 range, it's a little bit less. So at least that's what we're seeing.
And how many total TIC units have you seen go on the market this year, roughly?
Roughly this year, gosh, at least 100. It's hard to say. A lot of communities have multiple units within them. A lot of them are at least 4. Somewhere 80 to 100, 70, 80 to 100 or so. It's hard to keep track. I honestly have given up. I used to have a really nice spreadsheet where I kept track of every TIC in LA. Oh, it's sold. Here it is. Oh, now we know. It's like I had to give up on that months ago, and it's impossible now. It's a full-time job. So it's quite active. It's quite dynamic. There are a lot of players in the game. There's established players and there's new players, but the value proposition is there. I'm always happy to go out and look at buildings too and meet people. If you have a building and you think, I don't know, maybe this is a TIC, but I'm more than happy to go out. I'm down in Los Angeles every other week practically. And so, that's always one good thing, is just to kind of start and look at the property and walk through it. So, yeah.
And then, not that you want to go down this route, but since you did bring it up, the foreclosure route. So say you have one, you're in a 4-unit property. One of the tenants in common is not paying either their mortgage and or their HOA. Oftentimes it's both, like you said. What is that route? Have you had to go down that route? And what's it like for all the other owners?
Most of our experience is really dealing with it on a limited handful basis in San Francisco. I don't think there's been a foreclosure situation in Los Angeles that I'm aware of. And it was you know, sometimes the only way to characterize it is it was much to do about nothing. And that is that the borrower fell into arrears, couldn't work something out with the bank. It was a true foreclosure. They recognized it, and the bank inherited the undivided interest. So in any of these situations, if there is a true non-default or defaulting co-tenant and they have to leave, the bank becomes the co-tenant. So if we take over the property via foreclosure, we become part of the TIC agreement. We're your neighbor all of a sudden, so to speak. We're part of the HOA and the TIC. We're the co-tenant. And for that interest, we're not Bob anymore. Now Sterling is Bob. But we're not going to be in the business of living there, doing anything, or maintaining the unit. We are going to simply try to turn it around and sell it. So our process back then in 08 and 09, there was maybe 8 or so foreclosures. It was just a matter of fix the unit up, get it ready, and get it back on the market, get an agent, and sell it. And, you know, that's honestly really what happens. And that's all there really is to it.
And have you had any foreclosures during the COVID period?
Not that I'm aware of. No. There may be, sometimes there's little things going on in the background that, you know, servicing knows about, but anything that would be, if there was a lot of activity, I would hear about it, and I have not heard a peep. So it has not changed. No, we have not seen a lot just because of COVID.
Really great information. Thank you so much.
You're welcome.
Are there any other questions before we let Henry go?
All right. Well, thank you, everyone. I'm around. You know where to find me, and we all look forward to seeing Hayworth. So when it's ready.
Thank you. Thank you so much, Henry, for your time. We really appreciate it. Definitely can share Henry's information. I had it up on the screen for a while, but if any of you are interested, feel free to reach out to myself or Anthony. We're happy to share that information.
And again,
thank you, everybody.
Yeah, thank you, Henry. For anyone listening, if you want to watch this again, it will be posted on YouTube tomorrow. You can search The Collective Realty, or it's on our Facebook page at The Collective Realty as well. You'll see it there, as well as all the other seminars and webinars we're doing to help you build wealth are there. So thank you so much. Well, is there anything else you have to say to wrap up? Or?
No, I think we're good. I really appreciate Henry and taking the time and doing that presentation. Between him and Andy Serkin, obviously we've had a master class now on how to create a TIC and how to finance a TIC. So if you guys have any interest in doing so, I've got a number of clients now who have been asking about doing the same thing. Happy to talk you through that process. I'm obviously in that process as we speak. So it's been it's going to be a wild ride, and we're excited to bring these to market. Like I said, it should be coming to the market in the next 3 to 4 weeks.
Great. Thank you, sir. One of our next seminars that we're going to be doing is all about credit. So understanding how credit is counted, how to improve your credit, everything you need to know about credit. It's going to be a quick 20-minute webinar coming up in about 2 minutes. So you'll all be notified about that, and that'll be posted on our YouTube channel as well. So again, thank you guys so much. If you enjoyed this, please comment, like, follow our Facebook page and our YouTube page. We've really been trying to build up our YouTube page, especially since COVID. So any feedback you could throw on YouTube page would be great. Otherwise, have a great week, everybody, and we will see you next time.
Thanks, everybody.